My dear students, today let's look into buyback of securities, advanced accounting in CA intermediate. We are going to take classes only on English because so many students have requested me to take classes in English. So from today onwards, all the classes will be only in English. Now, what is the meaning of buyback? Buyback means what? Buyback means purchasing our own securities from the open market or from existing shareholders or from the employees to whom we sold or issued some shares on employee stock option plan or bonus shares like that. So we are buying back, that is called buyback. So here the meaning, the purchase of own shares by a company and company having those company which have the sufficient fund may be able to buy back their own shares. Okay, what are the objectives and advantages of buyback? What are the advantages? We shall increase our existing earnings per share. How can we increasing? For example, 1 lakh shareholders in India, for a particular company having 1 lakh shareholders in India. But we are buying back nearly 50% of the share from the open market. Now, the shareholders will be only 50,000 shares. Normally, every year the dividend is to be given from out of the profit. For example, before receiving the buyback, 1 lakh shareholders are eligible for getting dividend. Now, only 50,000 shareholders are eligible for dividend. So, automatically the earning per share will increase. And then to increase promoters' earnings. Normally, the outsiders having influence into the affairs of our company. In order to curtail, we are concentrating our own promoters. So, the shareholders, only the promoters will have more shares, their earnings will be more. And then it has to support the share price in the stock exchange. Automatically, if you buy back, automatically the share price, supporting price of our shares in the stock exchange will be increased. And then to pay surplus cash to the shareholders, we have to pay surplus cash. For example, if you are buying back, normally the shareholders will be lower. Low limit of the shareholders will be here. So, out of the cash, surplus will be shared among the existing shareholders. So, that share will be more. Now, what are the sources available in order to buy back our securities? Whether that's sufficient cash or sufficient reserves within the balance sheet, we have to see. According to the Companies Act section 68(1), we can buy back, we can buy back our own securities out of reserves and security premiums. There are so many reserves: revaluation reserve, general reserve, and then capital redemption reserve, and then security premium, and so many reserves. So whether there are sufficient reserves within our company. Apart from that, for example, if you are going to issue, you are going to buy back our equity shares, we may issue accordingly the preference shares to that extent how much money needed for buyback of our equity shares. As per section 62 of the Companies Act 2013, there are some important provisions before buying back. What are the provisions? First of all, the buyback is authorized by its articles, whether it is authorized or not, by its articles of association. And then we have to pass one special resolution. It should be passed unanimously in the general meeting. And then the quantum of buyback, how much it is the quantum of buyback? That must be equal or less than 25% of the total paid up capital and reserves. That means it must not exceed 25% of the total paid up share capital and free reserves. And then there is a debt to equity. What do you mean by debt to equity? For example, if you have a debt to 1 lakh, for debt to 1 lakh, equity must be 50. So, you can raise the loan from outsiders as a debt 2 times of your equity. So, the ratio of the debt is not more than twice of its reserves. Paid up capital and reserves. So, it must be 2:1. And then, all shares must be fully paid up. Only fully paid up shares can be bought back. Partly paid up shares cannot be bought back. Please understand. And then one more thing, in accordance with the all procedures, whatever the procedures we are carrying out in case of buying back, must be in accordance with the regulations of SEBI. SEBI means Securities Exchange Board of India. And then in accordance with any guidelines as may be arising, as may be prescribed in future. So these are the preconditions, provisions as per section 68(2) of the Companies Act. There are other provisions. Number 2, the notice must be accompanied by explanatory statement. Why? What is the notice? Actually, the special resolution is to be passed in the general meeting for approving, for getting the approval from the shareholders. For general meeting, we have to issue notice. The notice must be accompanied by explanatory statement. What is explanatory statement? The statement which contains which class of shares we are going to buy back and what amount to the extent to which we are going to buy back. And then what is the time limit for the buyback is to be completed. And then point number 3, it must be even if you pass the special resolution in the general meeting, after passing the special resolution, it must be completed within 12 months from the date of special resolution. From what source we are buying back? We have to buy back from the existing shareholders and then from open market and then from employees. How it is possible from employees? For employees, we may have issued some employee stock option or we have issued some bonus shares. So from whom itself we may buy back the shares. Point number 5. After completion of buyback, within 7 days of the completion, the company must destroy all all securities. Either physically destroy the securities or extinguish the securities. And then point number 6. When a company completes a buyback, it shall not make further issue of same kind of equity shares. And then the company has to maintain a register containing all particulars. Whatever the buyback is going on, and then what are the shares, and then what kind of shares, the extent of money bought back, and then the time, within the time limit we bought back. So these are the conditions must be mentioned in the register. So a return is to be filed with both registrar of the companies and then Securities Exchange Board of India within 30 days of the completion. So after completion of the buyback, a return is to be filed with SEBI and registrar. Apart from that, if the company makes any default, it is punishable. The company may be punishable with the fine of rupees 1 lakh, but which may extend to rupees 3 lakhs. So minimum 1 lakh, maximum 3 lakhs. It may extend. But every officer of the company will be punishable with the imprisonment of up to 3 years along with the fine of rupee 1 lakh, which may extend to 3 lakhs or sometimes it may be with both. Point number 10. Sum equal to nominal value of shares so purchased shall be transferred to the capital redemption fund. For example, if we have 1 lakh shares, paid up shares, out of that we buy back nearly 30,000 equity shares. So 30,000 shares, what is the nominal value? The nominal face value of shares rupees 10. So 30,000 rupees into 10, 3 lakh rupees. So 3 lakh rupees must be transferred to the capital redemption fund. It is to be treated as a reserve. It will be shown in the balance sheet liability side. Sometimes whenever it is necessary, we may use this capital redemption fund. If there are some unissued shares to the members, we may issue. But what is the process? So we can use this capital redemption fund in order to beat out the unissued shares, because we are going to issue the unissued shares to the shareholders as a bonus shares. Bonus share means no payment we have to receive. So it may be utilized for this purpose. And then premium on buyback. For example, 10 rupees shares we are buying back 12 rupees. So 2 rupees is a premium amount. That premium amount must be adjusted against free reserves or security premium account. Normally it is to be adjusted from security premium account.